Everyone's talking about how Elon Musk is going to dominate the global EV market. But here is the number nobody is mentioning. BYD just finalized the timeline for its Subang plant in Indonesia this week, aiming for a Q1 2026 opening with an initial capacity of 150,000 units. Tesla isn't even in the top 3 for Southeast Asian EV registrations this month.
150,000 units? That's not a trial run, that's a full-scale invasion. And welcome back to Asia Tech Macro. I'm Maya, coming to you with the move fast and break things energy of a tech founder, and with me is Alex, who spent a decade at a hedge fund and still refuses to believe any growth chart unless it's backed by physical commodities.
That's because you can't download a car, Maya. And that brings us to our first deep dive today. I was just reading this morning that Indonesia's Minister of Investment, Rosan Ruslani, confirmed that the $1.3 billion BYD investment in West Java is moving a year ahead of schedule. But here's the macro part most people miss. Jakarta isn't just selling nickel anymore. They're using their 21st century oil, nickel, to force a technology transfer that includes local AI training and data center hubs.
It's a resource for tech swap. I saw the comments from Lu Shouyang, BYD's general manager for the Asia Pacific. He was very specific about bringing the Zhengzhou superfactory tech to Indonesia. But Alex, let's be real. Isn't Indonesia over-leveraging itself to Chinese capital? Over 18,000 new jobs are being created by this one plant alone. If Beijing sneezes, Jakarta catches a fever.
That's a fair critique, but look at the alternatives. In 2022, everyone thought the US would lead the green revolution. In 2026, the data shows that China is the only one actually building the hardware at scale. I saw a report from HSBC's Asian research team yesterday. They noted that Indonesia's tech-related FDI grew by 22% in 2025, but almost 60% of that was from the GBA, the Greater Bay Area in China.
Okay, but devil's advocate here. What happens if the solid-state battery breakthrough we're hearing about from Tokyo actually hits the market in 2027? Solid-state needs less nickel. Doesn't Jakarta's leverage just evaporate?
That reminds me of what people said about coal in the 90s. It'll be gone in 10 years. Well, look at the grid in Java right now. But here's the thing. Indonesia is playing a speed game. They want to lock in the manufacturing ecosystem now so that even if the chemistry changes, the factories are already there. It's about building the industrial muscle memory.
Speaking of muscle memory, we have to talk about China's new brain. On January 20th, the Cyberspace Administration of China, the CAC, dropped a massive set of guidelines for autonomous AI agents. This is the first of its kind globally.
It's a classic Beijing preemptive strike. They are regulating the tech before it even matures. I saw an analyst note from Jefferies saying this could delay the export of Chinese AI SaaS products by at least 12 to 18 months. They are requiring agent traceability and real-time moral auditing for any AI that can make decisions on behalf of a user.
18 months? In the AI world, that's an eternity. If I'm an AI founder in Hangzhou right now, I'm looking at Singapore or Dubai as my new headquarters before my coffee gets cold. But wait, Alex, is this actually a kill switch for innovation? Or is it just the government making sure that AI agents don't start their own political movements?
It's both. But let's rephrase that. It's about sovereignty. Beijing wants to ensure that sovereign AI means the state remains the ultimate admin. But here's what most people miss. This regulation might actually make Chinese AI agents more attractive to other authoritarian regimes. It's a governance-as-a-service export.
That is a terrifyingly brilliant take. Safe for the state AI.
Precisely. Now, let's move west to India. I was just reading this morning that the Indos initiative is moving into a new phase. We're hearing reports that the Indian government is considering a mandatory Indos standard for all smart TVs and government-issued mobile devices by late 2026.
I saw that Mordor intelligence report that just came out on January 21st. They are projecting the India smart TV market to hit $26 billion in 2026, and a huge chunk of that growth is tied to these Indos devices. It's an $11 billion gamble for digital sovereignty.
$11 billion is a lot of money for an operating system that doesn't have an app store yet. That reminds me of what happened in 2022 when Russia tried to push their own mobile OS. It was a disaster because nobody wanted to build apps for it. India has the developers, but do they have the patience of the consumer?
Well, actually, I was just looking at the UPI numbers. Everyone said UPI wouldn't work, and now it's the global gold standard for digital payments. Why can't they do the same with a mobile OS? If you mandate it for the government and the massive public sector, you create a captive audience of 20 million users overnight.
A forced birth rarely results in a healthy competitor, Maya. But for an investor, the key isn't whether Indos wins, but how much it disrupts the Google and Apple duopoly in the region. If they even take 10% of the market, the revenue loss for the Silicon Valley giants is in billions.
It's a multi-billion-dollar game of chicken. But speaking of disruptions, we have to look at the hidden price of moving out of China. I was looking at the labor data from Vietnam and Malaysia this morning, and the numbers are starting to look, well, expensive.
You're seeing the success tax, Maya. I was just reading a report from an HSBC economist last Friday. He pointed out that wages in high-tech manufacturing hubs like Bac Ninh in Vietnam and Penang in Malaysia are up 15% year over year. 15%! That is nearly triple the regional inflation rate.
15%? That's massive. If I'm a hardware founder looking for low-cost alternatives to Shenzhen, those numbers make my stomach churn. Is it just a labor shortage, or is there something else going on?
It's a total war for talent. Every tech giant moved into the same 3 or 4 cities at the exact same time. They are cannibalizing each other's workforces. I saw a note from a supply chain analyst in Singapore yesterday. He said that for specialized technicians, the Penang premium is now so high that it's actually cheaper to hire in some Tier 2 cities in China.
That is a total reversal of the narrative. We've spent years talking about China plus one as a cost-saving measure. Now it sounds like we're paying a geopolitical insurance premium just to have a factory that isn't under Beijing's direct thumb.
Exactly. It's no longer about the bottom line. It's about the headline risk. If you're a CEO, you'd rather pay 20% more in wages in Vietnam than explain to a congressional committee why your entire 2026 product line is stuck behind a trade embargo. But for a shareholder, that 20% is coming directly out of your dividends.
That reminds me of what happened in 2022 when everyone panicked about energy costs. People paid anything just to keep the lights on. But wait, Alex, if the costs are equalizing, does that mean the China plus one trend is peaking?
Well, actually, let me rephrase that. The physical move is peaking, but the financial complexity is just beginning, which leads us to our contrarian corner.
Here we go. What's the consensus lie we're exposing today?
The consensus is that India is the new China. You see it on every magazine cover. The 21st century belongs to Delhi. India is the world's factory. But let's look at the cold, hard data from the last week. India's logistics cost as a percentage of GDP is still hovering around 13%. In Vietnam, it's 9%. In China, it's closer to 7%.
Okay, but devil's advocate here. India has the demographic dividend. They have millions of young people entering the workforce while China is aging. Surely that outweighs a bit of friction of the ports.
A dividend is only a dividend if you have the roads to get the workers to the factory and the ports to get the products out. I saw a report from Sanjeev Prasad at Potok yesterday. He was quite blunt. India is adding 10 million people to the workforce every year, but high-tech manufacturing is only absorbing a fraction of that. The rest are going into low-productivity service jobs.
So we're building a digital giant on an analog foundation?
Precisely. The contrarian view is that India isn't the new China. It's a completely different animal. It's a service-led digital powerhouse that might never actually dominate physical manufacturing the way Beijing did. If you're investing in India expecting 1990-style Chinese growth, you're going to be waiting a long time.
That is a tough pill to swallow for the manufacturing renaissance crowd. But it makes sense. We're trying to force India into a 20th century box when they're already living in a 21st century digital economy.
Spot on. So for investors listening, you should be buying the Indian software and middleware dip, not the Indian factory hype. Look at the companies making Indos work, not the ones trying to build a new highway through a mountain.
Okay, Alex, let's get practical. We've covered a lot of ground today, from BYD's $1.3 billion bet in Indonesia to China's AI agent moral audit and the wage wars in Penang. So what should you actually do?
Action item 1. Watch the BYD-Japanese partnership rumors. If you see a major Japanese automaker like Toyota or Honda starting to license Chinese EV platform tech in Indonesia, that's your signal that the Japanese dominance in ASEAN is officially dead.
Action item 2. For tech investors, look at the interoperability players in India. Don't worry about whether Indos beats Android. Look at the companies that make apps and payments work across both. They are the Switzerland of the digital war, and they will win no matter who owns the OS.
And action item 3. Keep an eye on the Vietnam wage decree coming next month. If they hike the minimum wage again to curb the 2026 inflation spike, the China plus one trade is officially a political trade only. Adjust your margins and your expectations for low-cost hardware.
Great stuff, Alex. I think our listeners have enough data to keep them busy, and hopefully a little bit skeptical for the next 7 days.
Data is the only hedge against volatility, Maya. I'll see you next week for our deep dive into the digital bot and Thailand's surge into the world of central bank digital currencies.
I'll bring the coffee, you bring the cynicism.
Deal.
Thanks for listening to Asia Tech Macro. Don't forget to subscribe on Spotify or Apple Podcasts, and check the show notes for the analyst reports we cited.
Stay data-driven. See you next week.
Bye.
Goodbye.